Picture this. You've spent years building your business, your career, your investments. One day you look up and realize this isn't just doing well anymore. You're firmly in high net worth territory. Maybe there's a couple of homes, a sizable portfolio, a business or two, some private deals, kids' college already handled, and people starting to ask you for advice or for money. And then it hits you. Managing wealth is a different game than building it. This video is about that shift. Not about the hottest stock or the newest fund, but about how high net worth people can think strategically about investment and wealth management so that money becomes a tool for freedom, impact, and stability, not stress. Start by reframing what wealth management actually means. For a lot of people, investing equals picking stocks or hiring someone who does. For high net worth families, that's only one piece of the puzzle. True wealth management is integrated. It's the alignment of your investments, your taxes, your estate plan, your business interests, your philanthropy, and your family dynamics around a clear vision of what you want your wealth to do. So the first big question isn't, where should I invest? It's, what is this money for? When you strip away the noise, wealth tends to serve three main purposes: security, lifestyle, and impact. Security is about never having to worry about the basics again: your home, healthcare, core living expenses. Lifestyle is funding the way you actually want to live: travel, experiences, hobbies, maybe that vacation home you love. Impact is everything beyond yourself: helping family, backing causes you care about, building something that outlasts you. Most people skip this step and jump straight to products. But if you're already wealthy, clarity of purpose becomes the highest return activity you can do. Once you know what you want your money to accomplish, you can segment your capital and invest it intentionally, instead of letting it sit as one big blurry pile. A useful way to think about this is in buckets. You might have a safety bucket, a growth bucket, and an aspirational bucket. The safety bucket is money you do not want to lose: cash, high-quality bonds, and assets earmarked for essentials. The growth bucket is long-term, diversified investing meant to outpace inflation and support your lifestyle over decades. The aspirational bucket might be concentrated or higher-risk plays: your startup investments, private equity, venture, or that one big long-term conviction idea you're willing to ride out. Each bucket has a different time horizon and risk tolerance. When you match your investments to the right bucket, the day-to-day noise of markets becomes much easier to ignore. A downturn in the growth bucket is uncomfortable, but it doesn't threaten your core security. A risky private investment going sideways is disappointing, but it doesn't derail your retirement. That separation lets you be more rational and less emotional. Which brings us to one of the biggest issues for high net worth investors: concentration risk. Many people with significant wealth got there by being concentrated. You built and sold a company. You held a large position in your employer's stock. You went all in on a sector at the right time. Concentration is a fantastic engine for creating wealth, but it's a terrible strategy for preserving it. The brutal truth is that any single asset, a stock, a property, even a business, can fall much further and stay down much longer than feels reasonable. The more your lifestyle, legacy, and family depend on one thing working out, the more vulnerable you are. This is where diversification stops being an abstract financial word and becomes a very real form of risk management. It doesn't mean owning a random collection of things. It means deliberately spreading exposure across different asset classes, sectors, geographies, and strategies so that no single failure can permanently damage your long-term plan. You can still keep concentrated positions if you choose, but ideally within the aspirational bucket, with a clear plan for how much is enough and how you'll gradually de-risk over time. For most high net worth investors, the core of that diversified portfolio is still fairly boring: a mix of global stocks and high-quality fixed income. Equities give you ownership in businesses around the world and a chance to grow with the global economy. Bonds and other defensive assets provide stability and help you sleep at night. The exact mix depends on your goals, age, and ability to tolerate volatility, but the principle is consistent. Let broad, disciplined exposure do the heavy lifting instead of constantly chasing the next big idea. On top of that core, many wealthy families add alternative investments: private equity, venture capital, private credit, hedge funds, real estate partnerships, and more. These can offer attractive return potential, different sources of risk, or unique tax benefits. They can also be complicated, illiquid, fee-heavy, and highly dependent on manager skill. The key is to approach alternatives with clear eyes. Understand lockup periods, capital calls, and the true risk profile. Ask how an investment actually fits into your buckets and your overall allocation. A private equity fund that ties up capital for 10 years is not a substitute for your emergency cash. A hedge fund that can swing wildly month to month is not the right place for money you'll need in 3 years to pay for a child's education. Alternatives can be powerful tools, but they should serve your plan, not define it. Now, let's talk about something high net worth investors often underestimate: taxes. At your level, taxes are not a side detail. They are one of the largest expenses on your portfolio. Two investors can earn the same pre-tax returns, but the one who manages tax impact effectively can end up dramatically ahead over time. Tax-aware wealth management involves several dimensions. There's tax-efficient investing, choosing when to realize gains, using losses to offset gains where allowed, holding certain assets long enough to benefit from favorable rates. There's asset location, placing tax-inefficient investments in tax-advantaged accounts when possible, and holding more tax-efficient positions in taxable accounts. There's planning around business exits, stock options, and liquidity events to avoid surprises. And then there's the larger structure, using appropriate entities and trusts, where suitable and lawful, to manage estate taxes, shield assets, or organize family ownership. None of this should be done casually or based on generic tips. It's an area where your financial advisor, tax professional, and estate planning attorney need to be talking to each other, with you at the center, understanding the big picture. Speaking of structure, as wealth grows, so does complexity. You might have operating companies, holding companies, trusts, real estate entities, and cross-border considerations. Done well, structure brings clarity. What sits where, who owns what, how cash flows, and what happens if something goes wrong. Done poorly, it's a mess that no one fully understands, which becomes dangerous in a crisis or transition. This is where you move from just investing into true wealth architecture. You're not only asking, is this a good investment, but in whose name should it be held? In what entity? With what rights today and what protections for tomorrow? Those decisions affect liability, taxes, control, and inheritance. Another often overlooked piece is liquidity. When you're wealthy, it's easy to become asset-rich and cash-poor, especially if you favor private deals, real estate, or your own business. The portfolio might look impressive on paper, while your actual flexibility is limited. Effective wealth management makes sure you have ample liquidity for several things: the inevitable surprises, the known upcoming obligations, and the opportunities that appear when others are forced to sell. That usually means holding more boring cash and short-term reserves than you emotionally enjoy. But remember, optionality is an asset too. Being able to act when markets are dislocated or when the right opportunity appears can be one of the quiet superpowers of having wealth. Now shift from the financial to the human side, wealth and family. Money amplifies everything: generosity, creativity, but also fear, entitlement, and conflict. As your net worth grows, conversations about values, expectations, and boundaries matter just as much as conversations about returns. How much do you want your children to know, and when? What support do you want to provide, and what do you want them to build on their own? How do you help without removing their drive? Some families create a simple family mission for their wealth: why it exists, what it should and shouldn't do. Others hold regular family meetings where financial education, philanthropy, and long-term plans are discussed openly. The point is not to turn your family into a corporate board. It's to avoid a situation where your wealth outlives you, but your intentions do not. Legacy planning brings all of this together. Your will, your beneficiary designations, your powers of attorney, and your trust structures, if you use them, are the rule book for what happens when you're no longer able to decide. Without that rule book, the default is usually complexity, cost, and strain on the people you care about most. Thoughtful estate planning isn't only about minimizing taxes, it's about matching who gets what, when, and under what conditions to your values. Maybe you want to provide full financial independence. Maybe you want to give partial support and encourage your heirs to make their own way. Maybe you want a meaningful portion of your wealth to support specific causes through vehicles like donor-advised funds or foundations. All of that comes back to the question from earlier: what is this money for? At this level, you are rarely doing all of this alone. That brings us to your advisory team. The quality of your decisions will often mirror the quality of the people advising you and how well they collaborate. Typically, that means a financial advisor or investment manager, a tax professional, and an estate planning attorney at minimum. If you own businesses, there may be additional specialists. The key is to look for advisors who are transparent about how they're compensated, clear about their responsibilities, and willing to coordinate with each other. You want people who start with your goals and family context, not with products. People who can say no to a deal that doesn't fit, even if it's profitable for them. People who are comfortable telling you the truth, especially when it's not what you were hoping to hear. In the end, investment and wealth management for high net worth people is not about maximizing complexity. It's about aligning big resources with a clear, human story. You've already done the hard part, creating the wealth. Now the work is to design around it, so that markets can fluctuate, businesses can cycle, and the world can change while your core security, your lifestyle, and your impact remain resilient. If there's one takeaway from this video, let it be this: don't let your wealth just happen. Take the time to define what you want it to do. Build a structure and portfolio that supports that vision, and surround yourself with a team that can help you execute it wisely. Because at this stage, the goal isn't just to have more. It's to live better, give better, and ensure that what you've built truly serves the people and purposes that matter most to you.